Welcome to Breaking Banks.
TechCrunch reports fintech accounted for 21% of all venture capital dollars raised in 2021. When things go up, they also have a Newtonian way of coming down. The same article says that 10% of all layoffs in Q2 came from the very same fintech sector. Neobanks such as Chime, Nubank, Klarna, Revolut, they were rocket ships that have now had to pull IPOs and take massive valuation haircuts. Does this signal the end of neobanking? Ron Shevlin, Chris Skinner, and I debate what's next for Neos. And in the second half, Amber Buker, formerly my partner at Alloy Labs, where she led strategic insights, decided a global economic meltdown was the perfect time to start, wait for it, a neobank. Let's find out what her strategic insight was. Tune in. It is not as crazy as it sounds. She even convinced Alloy Labs Alchemist Fund to invest. That's both a disclosure and a vote of confidence. This week on Breaking Banks, is it the end or the end of an era? All right, the big news over the last couple of weeks is it turns that there has been a return to Earth. As gravity has taken full effect for a bunch of the neobanks, coming back, and raising at valuations that are fractions of what they were before. And Chris, why don't we start with you about what's the view from, the European take on folks like Klarna and Monzo has been strangely quiet, in terms of how things are going. What is the atmosphere from a European perspective when it comes to the neobanks?
Well, first of all, we need to clarify what we mean by a neobank, and that some have full banking licenses like Monzo and Starling. Some just have a money and payments license like Klarna. And there's a big difference between all these players. And looking at the world, not just Europe, what we're seeing is a number of them struggling with financing and funding rounds. Obviously, if they're privately held, that's a key issue for them. The runway has narrowed a lot, particularly this year, with what I would say is a recessionary factor, which I know Ron will talk about. But when you look at Varo, for example, in the USA, that's a big issue for them. I think it's a big issue for Klarna and for Monzo, to be honest. Some of the big issues are around the way in which they've developed. So there's a number of challenges out there. The biggest challenge, when I look at N26, for example, a German digital bank, and I'll clarify, if I say neobank, I mean a bank, like a fintech without a banking license. If I say digital bank, I mean one that has one, or challenger bank is one that has a banking license. And N26 has one, but they've walked into a lot of trouble in the way in which they've onboarded customers, because when they started, it was light licensed banking, and then they became full licensed banking, and they didn't re-onboard their customers. And so their KYC, know your customer processes, have been particularly at issue. But this isn't going away. I mean, we're seeing new banks, both Neo and Digital Challenger, launching in Middle East, Africa, Asia, South America. Particularly my favorite is Nubank in South America, which I could talk about extensively, because I was recently in Brazil talking to an audience there around what's happening with neobanking and digital banking. But rather than hogging the whole of this episode, I'll let Ron give his comments as well.
Yeah, I'm going to comment under protest here. I didn't realize I was coming on to debate Chris Skinner, because I'm not that stupid to do that. So
I know that's why I had to trick you into being here.
I was like, oh my God.
I like a debate. Come on, Snark. Come on, Snark me.
Yeah, I like debate too. I just like to pick my opponents a little bit more carefully, I get people I think I can win in a debate. So I would not dispute Chris's definitions of neobank. It's my kind of take on the article that I published, and I'm having to find myself explain it a little bit, was that I think the neobank era is over. Not that neobanks are dead and the ones that are existing aren't going away. I got an email from a CEO of a neobank, or what I like to call community fintechs, because many of them that don't have a a license can't really be called a bank, and because they tend to focus on affinity groups. So I've often used the example of Panacea Financial, which I'm a big fan of. They support young physicians, and sure enough, got an email from the CEO of that company yesterday saying, I totally disagree, we're doing really well, blah, 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 blah. And it's like, well, yeah, I use you guys as an example all the time. But to me, the typical neobank, whether they have a license or not, has been, in the US at least, a fintech who has come into the market with the idea that there are these underserved consumers, generally low to middle income consumers, who are being underserved by traditional banks because the banks won't lend to them, or because banks overcharge them with overdraft fees and monthly fees and things like that. And whose business models tend to rely on interchange as the revenue mechanism, which they often have to share with a bank partner who's providing the license in the background. And my take has been that I think the past 10 years has kind of proven a couple of things. Number one, that interchange is not a business model to hang your hat on. Especially if you have to share it. But regardless, because of the payment trends that consumers have, and Chris, it was interesting, you wrote a rebuttal to my article, and you were actually honing in on my points about primary the consumers who consider a neobank or any bank their primary. And your point was, hey, we just have accounts that do things. And in effect, you're absolutely right in many ways. And it actually kind of makes my point, is because people have so many different accounts that they use to make payments these days, that even a challenger bank, neobank, digital bank, whatever you want to call somebody like a Chime or a Varo, who has run up millions and millions of accounts, reality is that even their customers are spreading their payments behavior over lots of different accounts. So fundamentally, my point was that not that these banks are going to go away. It's really hard for me to imagine Chime going away with, $1 billion of funding behind it. But my point was that the neobank era, the era of VCs pumping $1 billion into startup fintechs who are going to go after low to middle income consumers who are spreading their payments behavior over 10 different accounts and who aren't very good lending prospects to begin with. I don't see another Chime coming along. Not that these existing fintechs are going away, but that I think we've seen the end of the funding.
Well, and I think Volt makes a great example of that, right? Like when you look at the number of customers they had and the amount of funding, it's like, how did this happen? And how did you have so few customers for that much money in terms of what you've raised? That I wonder, is it a systemic issue in terms of like, where do we begin to say like this ends? Is it because the business model was fundamentally flawed, right? Basing a business on interchange, and then when you share interchange, it's worse, and interchange is going to get perpetually squeezed. Is it the VCs that were pumping growth versus value? Where do we at? What does the next era look like? Ron, why don't we start with you and then go back to you, Chris, around if it's the end of an era, what's the next era we're entering?
I think the next era is the affinity focused fintech. What goes after says we're going to be more like lifestyle providers, where financial services is just a segment of the products and services that a startup provides, or that they're providing something specific to the platform. So it's more I think it's the embedded, whether it's embedded finance or an embedded fintech. That's where the embedded fintech is a financial institution embedding other fintech firms, or really other firms' products and services into their platform, or where the fintech or bank is embedding their services into a brand or some other fintech's products and services that goes after a more narrowly defined segment, but not defining it by low to middle income consumers, which so many of the early neobanks have defined their market as.
Yeah, I mean, from what you're saying, I think the US market might be different to Europe and the rest of the world because the neobanks, challenger banks, digital banks are not driven by interchange. They're driven by customer engagement and then expanding footprint. They may start with a simple offer like a prepaid debit card, which is what Monzo did, and then expand into more full financial services. And in that context, it's about lifestyle services, particularly with a lot of these digital first banks, rather than the more complicated products like mortgages, which they'll leave, or foreign exchange services, they'll leave those to the traditional banks at the moment. Having said that, that will change because you have a lot of fintech startups that can do mortgage brokerage or mortgage servicing and FX. In particular over here, for example, Wise and Revolut started in that space, so they're being very successful there. I think the issue we have is twofold. So first of all, I should say that I think Ron and I are in violent agreement about the neobank era of doing what they've done so far is over. I think there's still a lot of room for new neobanks, but the issue I have is a lot of the neobank and challenger bank community and have been emulating and copying what traditional banks did and moving it into apps and services for the smartphone. They haven't reinvented financial services. And I continually tell any fintech startup what you should be doing is either fixing what banks do badly or creating something that banks don't do. And that's a very simple message. And I think too many believe they're fixing what banks do badly, but they're not actually fixing the issue that a customer has, which is the way in which I want to be served. And I'll give you a clear example, which is when I use some of the UK challenger bank services, I get alerts all the time about what's dynamically happening in real time on my account. I don't get any real-time alerts from my old bank. I have to go into the app to look at what's happening. And that means my old bank then says, we're the best digital bank in the world because Chris Skinner opens the app twice a day and never opens the app of his neobank. And that's where I think we're getting into the hub of the difference. I think the second big issue for the neobank community is that they got this hype of the VC and private equity markets, where I was actually really shocked to see that typically most of the new banks were being valued at $1 million for every 1,000 customers. Or, when you think about that, that's actually ridiculous in terms of their valuations. For some, that was even a lot higher. And I think there's a reality this year because of the recession and the dynamics of the markets taking place. By way of example, Klarna went from a $45 billion valuation last year to a $6 billion valuation this year. That's the reality starting to click in around what's actually happening here. It's not all about the tech. But where I was giving the rebuttal, if you want to say, Ron, was at the end of this, there will be some very successful digital and challenger banks that come out of this process, like Nubank or Starling Bank. I think they're my two big bets. And what's happening with them is interesting because they're focusing on open banking platforms with APIs and partnering and not trying to be control freaks and doing everything in a digital first economy where they can bring in appropriate other fintechs that they've done the due diligence around to integrate those for a better customer experience. And a little bit like the dot-com bust and boom, or boom and bust rather. When you came out of the bust, you did have Amazon, you did have PayPal, you did have a number of companies that have succeeded amazingly since 2000. We're going to see the same in a couple of years coming out of the fintech community, and particularly in the digital and challenger and neobank community.
I think one of the things, takeaway, Chris, that resonated with me is there seemed for a long time to be this disconnect between valuation and value to the customer. And everyone was measuring success based on valuation, not around the ability to serve, a community or a customer in a way that was, before totally underrepresented and they're willing to pay for. Ron, what do you think the business model of the future looks like, or where's the opportunity where there truly is unmet need that's meaningful?
I think it's in providing a wider range of services than just simply payment services or just simply lending services, to having a portfolio of products and services that you charge for that resonate with a particular set of customers. Either that, or you're a specialist and you're providing that specialty product or service to a lot of different, that's why I say it's sort of either the embedded finance or the embedded fintech model. I do agree a lot with Chris about the fact that these startups have not really reinvented anything, which is why I think the focus has to be on product reinvention, not customer experience. I've said this for a long time. I don't know if you guys were on Twitter yesterday when Jim Marous claimed to have like a trademark on some phrase. Well, I'm going to have my trademark on my phrase is going to be, nobody wants a digital bank. They want a better bank. And I think what a lot of the European neobanks coming into the US learned the hard way, like N26, like Monzo, like Revolut, was that we in the United States don't care that you're a digital bank. We want something better. And Revolut has succeeded more in providing international money transfer than they have being a general bank. And N26 has gone nowhere. I'm not even sure they're in the US anymore.
They're not.
Monzo either. So it's about sort of the product of innovation that's needed, not the customer experience innovation. And I'm glad Brett's not on this episode here, because he'd go ballistic over that, because he believes it's all about the experience. And I think where we tend to get into either the argument / agreement is that it's hard to distinguish between the product and the experience at some point. But I think Chris's point was they came in with sort of your standard product, but only, promising to provide something digital. So I don't see that succeeding. I think that's why, like, a lot of the neobanks in the US are not going anywhere. But like a panacea, it's focused more on a lending relationship than it is a payment relationship. And that's why, I mean, even SoFi, how did they start? Going after, affluent or affluent to be graduates of top schools to help them refinance their student loans, and built from there on a base of customers, and then of course got into a lot of different areas. And so, I think the point is you've got to kind of pick your target market first. Who are you going after? And I think this is where the neobanks failed, is they went after a segment of consumers that they were never going to make money from. And so what's next is more of the affinity era of really kind of honing in and specializing in on specific segments of the market, understanding their unique needs, financial or not. And like to Chris's point about Monzo in the UK, being more of a lifestyle, I think that's more a model. And although I am still a big fan of Starling, which is, I think, more of a platform model. But I think in the US, that's maybe a bit harder path to go down.
Yeah, I mean, I'll pick up on a couple of points from what you said, Ron, because what I find interesting is, going back to my comment, fintechs should fix the things that banks do badly in APIs through open banking, or do things that banks don't do, which might mean reaching out to different consumer segments that are not served, or small businesses that are underserved, which is happening. But the challenge in the latter group is the credit management and risk management in those sectors, particularly if there is lending taking place. Just offering a pure transactional service actually is quite interesting, because obviously there's so much innovation that we've seen in China and India and Asia in those areas that it's not neobanks, it's basically new models based on how to transact, some of them on platforms, some of them through APIs. And I come back to my model. So Jason, you mentioned what's the model, which is the front office is the apps, which could be in the Internet of Things on devices like your car or your telephone or your fridge. The platform is the internet itself, which is then an open banking API ecosystem of many, many, many players. I often refer to the fact that there's around 30,000 fintech startups around the world today doing one thing brilliantly well, whilst banks try and do 30,000 things averagely or badly. And that model has to change. It needs to be a integrated aggregation of the best in class services through the platform. That's the new model. And at the back end, it's the data analytics and the artificial intelligence. You can't have intelligence if you have done data. You've got to really get your data rocking and rolling. And I think what's happening is that, and I can see this in Europe, I don't know whether you see it in the US, but we're moving to a process-driven model through code, and the regulators will regulate those processes at the minutiae level of what something is trying to achieve, which might be a payment, but it goes below that in granularity to a merchant payment, a consumer payment, a issuer acquirer payment. And the whole way in which that ecosystem evolves is going to be really interesting, because today we tend to talk about regulatory requirements at a macro level, but we're moving to micro level services that need micro level regulations. And then my final point is, the ones that are succeeding the most in the neobank, Nubank, challenger digital bank space really understand, because they have people on board who are both digital and financial, where the soft underbelly to target banking is. And I don't know whether you've seen this in the USA, but when I mentioned Nubank, I really love this quote that was from their chief operating officer and co-founder, who said that if banks are Darth Vader, credit cards are the Death Star, and that's what they went to blow up. At the time in Brazil, typically a credit card would cost you $20 a month, and they went in with an offer of $5 a month because they changed the model. And as they proved they could do that, the regulatory resistance to new bank entrants in Brazil, the walls came down, because basically the regulator could see that they were challenging and doing it in a really good way that was appropriate. And then they added to their footprint. And I think that's what we've seen with Monzo and Starling, going back to those two, in that you start with a very narrow focus around how can you blow up the weak underbelly of a bank, and then expand the footprint, but in a pragmatic way through an open banking system. And those who do it that way will succeed nicely. So going to my opening comments, we will see some that succeed massively. And I've made the prediction that by the end of this decade, one of the neobanks or challenger banks will be acquiring one of the traditional banks or incumbent banks, depending on how you want to refer to them.
Potentially. And, part of what's interesting, in this theme, I keep thinking of Lindsay Davis and her graphic when she was at CB Insights, when it was the unbundling of the bank, when they went after that weak underbelly of one thing they do poorly. And I think the problem is now they all realize you can't make money on that one thing. So now we're seeing the era of rebundling, but we're rebundling back to what traditional banks have already done. We're not bundling in new ways. To Ron's point, what services do we get in? And I think let's go down that theme. What should we be adding in?
What I was saying is, we've seen the unbundling and rebundling discussion, but my positioning is, specifically when we talk about banking as a service, I continually come back to saying you cannot do banking as a service if you're not a licensed bank. So the banking as a service is the rebundling. That's what the banks should be doing. The unbundled pieces of processes in the area around that are what they should be looking at bringing into their ecosystem as partners through the platform. And so the unbundled processes is the process-driven APIs that are offered in the middle office. If you want to refer to it that way, I'd refer to it as through the cloud. And the understanding of that then gets interesting, because some really, rock and roll with this, like some of the banks I talk about in my books and blog, DBS in Singapore in particular, for example, really get this idea of integrating cloud partner services through APIs into a great customer experience that they're focused on delivering as a bank. And I just don't know whether many actually get this. Ron, what do you think?
Well, let's go back to definition a little bit, just so that everybody who's listening at least knows how we're using terms, or at least I'll tell you how I'm using terms. banking as a service to me is what the bank provides to either a fintech or a non-financial brand, because the fintech and the non-financial brand don't have a license. It's predominantly driven because of the need for it is predominantly driven because of the regulatory environment. Now, even if there was no regulatory environment, I still think there would be banking as a service, because I don't think every fintech and brand wants to build out every banking product that a bank already has. But I think that there are many banks, especially in the US, who are seeing the trend and trying to jump on the banking as a service bandwagon, not recognizing that their products aren't good enough. You still have to provide something of value. What's really different, I think, in banking as a service is that it's simply a change in distribution channel. Instead of going directly to consumers, you are now going, it's instead of a B2C model, it's a B2B2C model, in which you're going through some other business in order to reach customers. And it should be I think many banks don't like it because they think they're being disintermediated from the customer. Well, they're disintermediated from the consumer or the small business, but they just happen to have a new customer. The new customer is the fintech or the brand. And I think there's a lot more money to be made that way, and it could be a lot better model. So I think that that's a very attractive trend, and I think it's going to be picked up by a lot. But I think what a lot of banks aren't recognizing is the brand or the fintech is going to choose you as the banking as a service provider because you're bringing great products to the table and doing it, effectively, efficiently from a technology perspective. So, the API aspect to it is really important. The cloud delivery aspect to this is very important, but the product has to be there. And, things like real-time payments, real-time lending, crypto investing services, whatever it might be, has got to be there from a bank perspective. And Chris, you've been harping on this for 20 years. The banks have been super slow to digitize their own internal processes. How the hell are they going to do it if now all of a sudden they're just trying to turn their focus outward? So,
are you saying I'm a grumpy old guy?
Well, you are.
Yeah, I am.
I don't know about the grumpy part. Well, I actually don't know about the old part either. So, no, I would never accuse you of being that. I think the banking as a service trend has a lot of legs to it, but I think a lot of banks are jumping on the bandwagon without a real recognition of what they've got to bring to the table.
So I'll tell you a funny story, and that going back to I've been banging on the drum for a long time, and basically the main message is you build a physical business model as a traditional bank and added digital on top. You need to build a new model where digital is the foundation and physical is on top. And I call it omni-axis versus omni-channel. Omni-axis says you have a consistent, rationalized digital core. Omni-channel says you slap new technology on old structure. And I was talking to an innovative new idea of a company the other day where, because branches in Britain have been closing at a very rapid rate of the traditional banks, a lot of customers no longer have access to a human being or to a physical point of access to their financial provider. And we ended up talking about access as a service. And that gets interesting for me because we have infrastructure as a service, platform as a service, software as a service. Physical access as a service may be a very new dynamic marketplace that I've only just clicked onto because of that conversation, but it goes to the core of saying sometimes customers do want to speak to someone. And you may say, well, we've got a call center. Although one of my old jokes is, what's Google's telephone number? It's why Google won't be a bank. But the human face-to-face support of finance is actually, for me, an integral part of financial services that's undervalued and overlooked by many of the other commentators. And I think the idea of access as a service, where you have a multi-banked building with humans, is a really interesting proposition.
Well, I don't know, Chris. I here's where we may disagree. I've lived in my house now for 30 years. I've had the same for both house, home, and car insurance, the same agent for 30 years. If she bumped into me in the mall, Not that I've been in a mall recently, but I can't imagine where I'd really bump into anybody else. I wouldn't recognize, I wouldn't know her. She could literally walk right past me. I wouldn't know her. But we have used her extensively for 30 years. The first person we call when we've had an accident or anything happened to the house, and it's been a great relationship. But it's always been on the phone. And the point why the call centers don't work is because when you talk to somebody at the call center, they might as well be from Mars. They have no idea who you are. There's no history of the relationship. And that's why we walk into the branch, because we need to see the person physically, and because there's no other way to talk to anybody can be accountable for solving your problem.
We're deviating here a little bit because the main point was about the neobanks, but I'm kind of not necessarily saying you have to have the physical relationship unless you want it. And I understand what you're saying, Ron, about your relationship with your broker, but you probably know her name, you know her number, you know how to find her. And if you did want to meet with her because you had a need to have that connection, you probably could. But what was interesting during the middle of the conversation I had with this guy who had this idea was that when you look at the digital first banks, what's their next level of relationship? And at the moment, a lot of them don't even have a call center. Atom Bank in the UK, when I said, oh, you've got a call center, they said, well, actually, no, it's just a technical support telephone number. If you have a problem with the technology, it's not to talk about your transactions or balances or needs. And I just see there's an interesting development here around how access as a service will become something different. And it could be just telephone access, it could be physical access. I'm not saying you need the physical access, but some people do. I mean, when I walk into a bank branch, I see so many people who are there, to be honest, just actually because they wanted to have a day out.
Yeah.
So you're saying the Capital One Cafe has some legs to it. I want to go have a day out, so I go get a good cup of coffee. Ron, I knew you would bite on that one.
Now the one near me closed down.
Yeah, the last place I want to go for a cup of coffee. Well, gentlemen, thank you both for chiming in around the next era of banking. It'll be interesting to see what it looks like as, is it dinosaurs going extinct and a rise of a new generation, or is it just an evolution? So thank you both for the opinions, and Chris for staying up late, Ron for being up early to be on.
Thanks, guys. Nice to see you both virtually.
Well, Amber, I'm glad that you are still a host for Breaking Banks, because introducing Amber Buker, formerly known as the artist that was head of insights for Alloy Labs, but you've flown the nest, or the coop as the case may be, to go off and in all things go start a challenger bank. And so in the first half, Ron and Chris and I were talking about, is neobanking dead? And you followed this from the outset, from Bank Director, and then what we do with Alloy Labs and the number of banks we have that play within the banking as a service in the neobank space. Why of all times would you want to go leave and start a neobank now? And maybe we should start with, what's wrong with neobanks? Like, you have a Chris mind on this. Like, what's wrong with the system of neobanks as we see them today? And then we'll get into what you're actually setting off to accomplish.
Yeah, so I think the concept of a neobank, a challenger bank, an affinity bank, an identity-focused bank in our case, is a really beautiful concept that creates community in a digital space, which I think is something that we're all looking for more and more. But the fatal flaw, if you will, I think in a lot of neobank models is that they rely solely on interchange revenue, which I'm sure that you talked about with everyone before me. I like to say interchange is subject to change, and therefore is not something that you can really stake a multi-year, hopefully multi-generational business on. And so we've tried to kind of create a more anti-fragile business model that doesn't rely solely on that. But then, when we're thinking like, okay, well, what else can we do to make money as a bank that's not interchange? We really took it back to our founding story and what was important to us, so that we were aligning these other revenue opportunities with our mission and our vision for what Totem would be. And where that founding story started was with me trying to access tribal benefits. It was, in my case, it was a down payment assistance program that was really difficult to find anyone that knew about it. And then when I started to get more into this world of understanding these benefits and what's available, I started to realize how the tribes are actually dispersing the benefits is also a pain point for them. And so we started to think, okay, well, how can we build wealth in the Native community based on these assets that they already should have access to and clear up that pain point for the tribes? Well, there we go. Now we have some real revenue opportunity to provide value in a way that is, increasing access to benefits for our customers and also making the process of administering and distributing those benefits easier for the tribe. And now we have a B2B model, and in some cases a B2B2C model in terms of the tribes actually acting as our distribution partners for these accounts, that is much stronger than like a typical just direct to consumer play.
Well, and I loved, part of, this story in how it fits is affinity is not enough. Like, I like this idea of like, hey, we all crave affinity. I'm not willing to pay for affinity. And, in most cases, it has to be tangible value. And that's what you hooked me with in the totem story was there is value provided to each one of the stakeholders in this, whether it's the tribe that right now is sending, a paper check, maybe an ACH, but Native Americans are some of the most severely underbanked out there. I mean, surprised you don't trust the system after
Right.
your tribal lands have been stolen and just about every treaty's been broken. What's wrong?
There's no generational trauma there. No, definitely not.
No.
No. Clearly, yeah.
And so, this value, like it really is the story of you're taking friction out of the system, and that creates the opportunity for everyone benefits by doing this. It's not paying for a metal card or, paying because I want to put my own picture on the card or feeling, like literally and figuratively, I'm part of a tribe, that, this is more than just identity, it's value creation.
Exactly. It has to be something other than like a fun service that makes you feel like you're a part of a club. I think we've had that model for so long. And to your point about like buying the metal cards, like there are just so many things.
We can talk about this. I was tweeting the other day with someone that if,
can edit that out.
there was the first neobank for pet owners launch. It's like, listen, I can actually get behind this. You launch a chewy.com rewards program, I'm in.
Yeah. Oh my God. Really, of all times?
And we're going to use this screenshot that for everyone should know, this is Amber's puppy. Yeah.
Yeah, that's the puppy horse. No, but it, so having this alignment between not just having an account that says, hey, this is who I am, this actually helps me self-actualize in many cases. Native Americans are the fastest growing racial demographic group on the census. We had 160% population jump from the 2010 to the 2020 census. So it's a huge growing group. And this allows people to not only self-identify and say, this is another stake in the ground where I'm connecting with and claiming my culture, but it's also giving me access to, again, like these tangible benefits and opportunities to connect with my heritage that other folks are not, the other folks, it's really hard to create products around just a single affinity. Whereas when we're talking about your heritage, there's so many factors of that. We have a really long roadmap that includes products like a powwow finder and a charitable giving piece that will allow you to give to Native charities. I mean, the list goes on and on in terms of ways that we can engage that are meaningful and deep and, different than just a cool card with the right like picture on it.
Well, I mean, I do have a picture of Lola, my golden retriever, on my Capital One card, which is, even though it's expired, I still carry it. But that just goes to show how often I use that card. Right. So when you were bringing this together, and it was important to you to round out the team with other Native Americans, and as you were road testing this and running the idea, I'm curious what the reaction was from some of the people that you brought the idea to.
Yeah, so we did a concept test really early on when we were just kicking around the idea of, is this something that we should even think about doing? I've seen a lot of neobanks, and I was one of the people who believed that we were completely oversaturated in that market. So I wanted to make sure that I was, creating something potentially that people would actually want. We did a quick concept test, and what we found was that the reaction was really overwhelmingly positive. Over 90% of people loved, quote unquote, or liked the concept. 88% of our concept test respondents requested email updates from us throughout the lifespan as we build. And then 60% of the folks who did the test for us signed up for our account waiting list. And so, we were building an account wait list, just a few months into planning, which was really exciting. And what we learned from that was that it really was because of who and what we are. So we kind of positioned this as banking by and for natives, and that was the number one thing that stuck out to people. We were talking about, a spot me feature and a fee-free account and all of these other kind of little features that we added to the test. And people liked some of those, but far and away, the number one thing that people talked about in the qualitative responses was, hey, I bank with Chase or Wells or one of these big nationals, and the only reason I do it is because they have a good app and I can get ATM access anywhere. But if it weren't for those things, I would never bank with them. I don't want to bank with them. I don't like that I have to bank with them. And so we found over and over again that just the fact that this was specific to our people and a brand that they could ostensibly trust was what won people over and made them really want to see this product come to life. So it's not just the unbanked folks that we're targeting, although that's definitely a big part of our mission, is to get more natives banked. We're the largest group of unbanked people in the country when you're looking at race and ethnicity. About 16% of natives nationwide are unbanked. That bore out in our concept test as well. About 15.6 were unbanked of the folks that we surveyed. But what made us really excited was another 11% were already using a digital only bank. And then the rest were split out 50-50 between credit union and community bank users and those big national players. And so we feel like we have a really great opportunity to win market share from not just folks that are already unbanked, but folks that are already digitally banking and big national customers.
Yeah. Well, for the unbanked, to me, the opportunity there is when you're working with the tribe that wants to replace prepaid and sending paper checks, that have a tendency to get lost in the mail, or addresses, change, and there's breakage, and it's bad for everyone. This is what Hire One built their business on, as you and I've talked about, around how do you solve the problem for the university that needs to get student loan money into the hands of students, right? There's a natural wedge there, and it's bigger than let's just make it prettier, right? It's not about prettier. Yeah. It's actually real value and a cost savings for a number of them. Now, was anyone anti the idea? Like you said, of the 66, did you get any negative feedback?
We had literally like 2 people say that they would not open the account. So there wasn't a ton of backlash or negativity. I think, in terms of our customer base, we do have some significant trust issues to address. And so, I think that a lot of the kind of naysayers, if you will, were just like, who are these people sending me this survey? Like, I don't even know you. Like, why would I do this? It doesn't seem real, or it seems like you might be like getting taken for a ride or whatever. And so I truly think that the few naysayers that we had, once they see that this is a real product that is built by real native people and we can show them something tangible, that it'll make sense for them, and I have every confidence that we will win them over. Yeah, I'm trying to think about naysayers. It's interesting when we talk to tribal leaders, a lot of them get it immediately and they love the idea of having particularly kind of the financial literacy piece built in and getting more people banked. But of some of them, we tend to always run into folks that have some sort of tribally owned bank, financial service, payday lending product. And so for those folks, it's a little bit different conversation of figuring out like, okay, well, how can we partner? if you have a responsible, financial product, is there a way that we can talk about getting it in front of people, and, figuring those things out. But the reason why we're doing this is because there's a huge gap in terms of service for this market. There are 30 native owned banks in the entire country. So that's, not a lot of banks. And the ones that are out there, they're typically smaller in terms of their geographic footprint. They've got like maybe 1 or 2 branches. They may have a consumer app, but it's, like Jack Henry version 2018, or they technically have a bank, but it's really just kind of a mortgage operation, or it's really just kind of a CDFI, or, whatever the case is. So in terms of having an actual national brand that is for FDIC insured chartered accounts, there really is a big gap in Indian country for that.
So it's kind of a natural progression in your career, right? At bank director, you really followed the industry and, frequently published on it. You come to Alloy Labs. Now you spend a lot more time working on bank and fintech partnerships, including a lot with the BAS group. And now you leaped into, hey, I'm just going to actually go do this thing.
Right.
I'm curious, what's been the biggest challenge so far in standing up a fintech?
Well, I think that my challenges have been so much different than any other fintech founder because of that background that you mentioned. So, when you look at like the middleware providers, like the Syncteras and Bonds and Units and all of those guys, they are really interesting. They provide a really needed service for folks that don't have deep ties into the banking sector. Like if you don't have a bank partner and you don't know anything about compliance, that's perfect for you, right? Those were not my problems, right? I know a lot of banks.
Mm-hmm.
I know a lot about
70 plus of them,
At least. I mean, I interviewed hundreds of bankers at Bank Director for not just stories, but to build out the Finex tech. So like I had a lot of like the more rare, I think, knowledge when it comes to like diving into something like this and building something like this. For me, the biggest challenge, I mean, once I told you about what I was building, that took away a lot of challenges.
Hey,
in terms of just like having the time to and brain space to like have permission to think about these things all the time. So thank you, Jason, for being the world's best boss, and incubating new companies under your wing. But I mean, fundraising clearly is a challenge, and wrapping up the initial close for our pre-seed in a time when the market is going insane and tech stocks are falling like crazy, certainly is a little bit scary and stressful. But I even think that from that, we've been a little bit more insulated than others because of this very specific customer base that we're serving, and the availability of, there are so many more funds now that are dedicated to underrepresented founders, women founders, Black and brown founders, impact investors. So those folks have the same mandate no matter what tech stocks are doing, right? And so even there, I think we've been lucky to be a little bit insulated.
So what advice would you give if you were someone who doesn't come, deeply ingrained in the industry to start a fintech when they see a problem, whether it's on the business model or breaking in? What advice would you give to someone who wanted to start a fintech?
I would say make sure that you are solving a unique problem that is truly not being addressed by anyone else. I mean, I think that this is where we got to the point of saturation that we did with neobanks, is there are so many that are just kind of generic digital banking products that actually don't do a lot of other things. So I think starting with the problem is always the most important thing. Like, don't go build something for the sake of building it because you think you can. Wait until you find something that's actually needs a solution, but that is also worth fighting for. This is, this is something that what we're trying to address with Totem is something that I've felt personally that has impacted my life. It's something that, my heritage will always be a part of me. And so that's something that's not going to go away, whether the trend is, towards NFTs or away from Web3 or like all of these different shiny things that we chase so often in fintech. Having your business be something that you have personally experienced and felt and will always have a connection to, I think can go help take you really far in the times when it feels like everything is falling apart and all of the deals are falling through and people just aren't getting it. You need something that you feel really passionate about to get you through those times.
So if people want to partner with Totem, they feel they have something to provide the native people, or they're interested in getting on your waiting list, where can they find out more?
Yeah, so you can find us at mytotem.app. That's mytotem.app. And we are hiring also. So I will say that there's at least one, hopefully by the time this episode airs, several job descriptions up. So yeah, we're looking for tribal partners who want to, work with us to get your benefits paid out, add your benefits to our platform so that people can find them easier. Obviously, love a good account holder. So if you're a native and you want to get on our account waitlist, mytotem.app. If you want to work for a very mission-driven company, that's there for you too. And then we're on Twitter at Bank with Totem, and we are just getting started. So our kickoff is this week, and so we'll be hopefully posting fast and furious. We'll also hopefully just be a good account to follow if you want to, find out more about Native culture and be a supporter and an ally and an advocate for us.
Fantastic. And in full disclosure, Alloy Labs is an investor through our fund in Totem. So not only did we spin Amber out, spin her up, but we are investors. So good luck, Amber, and excited to see this mission continue.
Thank you so much, Jason. Appreciate you having me. It's fun to be on this side of the mic.
That's it for this week. If you like the show, make sure to give us a 5-star rating on your favorite podcast platform, or share it with a friend, or share it on social media.
We'll see you again next week with more Breaking Banks.